Yeah.
Great.
Okay. Just give me a second, please. Just give me 1 second, please.
Recording in progress.
Good afternoon, ladies and gentlemen. On behalf of EIH Limited and SKP Securities, it is my pleasure to welcome you to EIH Limited's Q4 FY23 and FY23 earnings webinar. We have with us Mr. Vikram Oberoi, Managing Director and Chief Executive Officer, and Mr. 𝗗𝗚𝗠𝗔𝗚, Chief Financial Officer. Kindly note, this meeting is being recorded for compliance reasons, and during the course of this discussion, there may be certain forward-looking statements which must be viewed in conjunction with the risks that the company faces. We'll have the opening remarks and a presentation by the management, followed by a Q&A session. Thank you, and over to you, Mr. Oberoi.
Thank you. Thank you so much, Naveen. And good afternoon, ladies and gentlemen. I believe there are about 60 people on the call right now, and thank you for joining us. You would have seen our results both for Q4 and for the financial year. And thankfully, we've had a very good year, a record year for the company, both at a standalone and at a consolidated level. And these results wouldn't have been possible had it not been for the dedication of all our colleagues who work hard to look after our guests to gain their trust and loyalty. So I must thank them. Of course, I would like to also thank our guests and people who've invested in the company for their faith in us. 𝗗𝗚𝗠 has a presentation, so I'll ask 𝗗𝗚𝗠 to present that, and then we'll be happy to take your questions. Thank you so much.
Thank you, Vikram. Good afternoon, ladies and gentlemen. So we begin the presentation with the key highlights of the Indian hospitality industry. This is as per the HVS ANAROCK report for February, March, and April 2023 edition, which basically puts out the key highlights of Q4, where, as per the report, the Indian hotel industry recorded its best ever performance since the pandemic began, with occupancies ranging from 70 to 72% overall and average rates exceeding rupees 8,200. Domestic air traffic in India has increased by close to 7% in March compared to the previous month, and it increased by 11% compared to pre-COVID levels. So indeed encouraging statistics. Mumbai, as per the report, was the market leader in March 2023 with occupancy rates exceeding 76% and the average daily rate of 11,000 rupees. EIH performance for Q4 is the best ever in the history of the company. It's a stellar operating performance where EIH has broken its own record several times over. Which is really shown in this slide, the blue line representing EIH-owned hotels and the golden line representing EIH-owned and managed hotels in India, where what is clearly visible is the fact that starting from the Q1 of financial year 2020, where RevPAR was around 6,500 levels, has now touched 15,000, which is pretty record breaking. I'm happy to share that EIH has demonstrated market leading operational performance. This is measured by STR reports, and the source, as is mentioned in the footnote, is the STR comp set, which EIH uses for its own and managed hotels. This data set is for all domestic hotels which are owned and managed by EIH. And as is visible that since over a 4-year period starting April 19 to March 23, the RGI has been consistently above 100, which is supported ably by the ARR index, which is also consistently over 100, which shows that or demonstrates that the hotel or the company has been able to command a premium in the industry. And this is primarily due to the company's unwavering commitment to quality and meticulous attention to detail that discerning guests yearn for. The premium positioning is also reflected in the awards and accolades that the company has received and the various hotels have received. The Oberoi Hotels and Resorts, of course, ranked the world's best hotel brand by Travel and Leisure USA in the world's best awards in 2022. It's been ranked the world's best hotel brand for service excellence by Travel and Leisure in India and South Asia also in 2022. It was voted, as you all remember, the best hotel group for 3 consecutive years by Telegraph Travel Awards UK 2019, 18, and 17. Of course, the next 3 years, because of the pandemic, the Telegraph Travel Awards were not held. Trident Hotels, incidentally, was also ranked amongst the best 5-star hotel groups in India by Travel and Leisure in 2022. And our individual properties, these are all listed out here. I'm not reading them out one by one. The Oberoi New Delhi, the Oberoi Mumbai, the Oberoi Gurgaon, the Oberoi Amar Vilas, the Oberoi Vande Vilas, the Oberoi Uday Vilas, the Oberoi Sukh Vilas, the Oberoi Beach Resort Al Zora, the Oberoi Marrakesh, and the Oberoi Beach Resort Mauritius. All of them have received plenty of awards and accolades as are listed here. And we are incredibly proud of these achievements and the recognition they bring to EIH Limited and our esteemed hotels. These awards reflect our ongoing commitment to delivering exceptional hospitality experiences that create lasting memories for our guests. As mentioned earlier, the financial achievements have also been unprecedented. We will cover them in 2 aspects here in this presentation. The first one is with respect to Q4 for standalone as well as consolidated. Standalone in revenues have increased vis-a-vis the same quarter previous year from 279 crores to 586 crores, which is a 110% increase. The EBITDA has grown by 621% over the same period, over the same quarter, from 34.6 crores to 249.3 crores. A similar set of results are evident for the consolidated results as well, where revenues have grown from 316.9 crores to 663.8 crores, and EBITDA has grown from 34.9 crores to 231 crores. There is substantial financial agility that is evident because of enhanced operational efficiencies, as you would probably notice, that the growth in EBITDA is actually, the growth percent in EBITDA is actually higher than the growth percent in revenue, which means that there is enough and more operational efficiencies that have really kicked in. And this is again evident here, where in Q4 of 2023, while revenue increased by 25%, over the same period, the total expenses increased by only 3%. Monthly occupancy trends in the Q4, occupancy ARR and RevPAR trends, which slightly softened in March, but seem to be doing better in the months after that again. City-wise, quarter-on-quarter, financial year 23 versus financial year 20 is as shown here, with Bengaluru recording the highest RevPAR growth, followed by Shimla, Chandigarh, Mumbai, Hyderabad, and Delhi, amongst others. The Q4 occupancy and ARR performance at domestic hotels, including all managed hotels. This is available in the presentation, and it's a slightly busy slide, so I won't take you through the individual data points. But essentially what we're saying is that whether it's ARR or RevPAR or occupancy, all of them have seen increases, substantial increases across the quarters that are compared here with. Food and beverage revenue also increased in domestic hotels, including managed hotels, from 143 crores to 222 crores, which is a 55% increase. And one of the heartening facts is also the strong bounce back in the OFS revenues, which have grown in quarter-on-quarter by 100% and is going strong. For the full year, it's a similar story here. Again, revenues going up from 1627 crores, the golden bars, in FY19 Q4, sorry, in FY19 full year, to FY23 at 1836 crores. EBITDA going up from 406 crores in FY19 to 626 crores in FY24. and the profit after tax going up from 113 crores to 320 crores in the standalone, and in case of consolidated from 149 crores to 329 crores. This is a depiction of the return on capital employed. So essentially, this is on a consolidated basis. The total capital employed on a consolidated basis minus the cash and cash equivalents and all current and non-current investments total up to 2,867 crore on an overall basis. The return on capital employed of this amount is 19%. And obviously the cash that is there and the investments that are there are being separately monitored. The cash will obviously be deployed going forward for growth of the company and will also be used to garner additional debt for projects going forward. If you were to look at the majority of this net capital employed, about 62% of this is deployed in hotel assets and in our investment property in Gurgaon, where the ROC ranges between 16% to 35%. And if one were to break that further up, one would see that the domestic hotel assets alone, they contribute. I mean, again, if you look at Oberoi Hotels, about 32.5% of the 1694 crores is deployed in Oberoi Hotels. And this is at historic cost, of course, where the return on capital employed is 45%. In case of Trident Hotels, it's 22%, which just shows that the fact that the Oberoi Hotels are premium also generates a very high capital employed, return on capital employed for the company. The company has demonstrated good financial resilience, strength, and debt management, as a result of which the year that we started with, we were at a net debt of 271 crores, which is now at a positive cash balance of 129 crores. This is on a net basis. Quarter-on-quarter and year-on-year trends. This is just to give a perspective. Direct segment has really over the years been going strong quarter-on-quarter and is really one of the best performing segments as of now. But corporate also has really picked up and reached pre-COVID levels. You could see the line which I've drawn to just demonstrate that the highest in all these quarters from FY20 to FY23 was in Q3 of FY20. And currently, as we speak in Q4 FY23, the corporate room revenues from corporate business has also gone up. Mines has also crossed well over the pre-COVID levels, etc. Leisure is just beginning to pick up, and especially with foreign leisure just beginning to come up. We have a separate slide on that as well. So the trend of foreign room nights basically shows that till February 2023, for Oberoi, for Trident, and all hotels taken together, the foreign room nights were well below pre-COVID levels, which indeed is very encouraging, because which just shows the optimism that one might really take away from this, because the foreign room nights, when they come back, they'll obviously contribute way more to the overall kitty of the company. We continue our efforts on carbon footprint. This is again some data points which you can go through in the presentation. And the performance highlights, I'm not again going through these because these have already been published, and I'm sure you have access to all of this. So with that, I'll just quickly reiterate the upcoming projects which have been announced. So we have two sort of projects. One, Bay Club in Mumbai, which has already opened in November 22. It's a world-class members-only club, and the first one that EIH is managing. We are also shortly due to launch a new standalone restaurant in Mumbai. And in FY24-25, there are 3 committed projects which have been mentioned here. In FY25-26, there are 3 again. And in FY26-27, there are 3 more. And there are under about 11 hotels which are under active discussion. And we shall shortly be announcing them as soon as they are concluded. The business footprint is again available for anybody who's interested in the presentation. And this is just the statistics about the number of keys, etc. Thank you so much. And we will be happy to take any questions that you may have.
Thank you, Kalol. Friends, anyone with a question, please raise your hands. We'll unmute you and take your question. We'll wait for a couple of moments just to let some questions line up. In the meanwhile, I've shared the investor presentation that Kalol just presented. So in case you want to go through it and you have some specific questions, please feel free. We have a question from Amit Agarwal. Amit, please go ahead. Amit, you're not audible. Yes, some connectivity issue. We'll go to the next question. Amit, if you can just try again. We have a question from Hari S. Hari, please go ahead. Please unmute yourself and go ahead.
Can you hear me?
Okay, now 1 second. Amit, you'll have to just wait for a moment, please.
Can you hear me, sir?
Yes, Hari, please go ahead.
Okay, sir. The few years ago, like decades ago, we are among the top 2 players in the industry, but now others have gone up in capacity, though not in our scale or luxury. But is the management concerned about this, sir? And the second question is this 30% revenue with 126 crores, what will happen to it after the new lease deed and buying of the Himachal government holding? What will happen to this amount? And the third one also, what are the plans on Andaman and Nicobar Islands? That's all, sir. Thank you.
Good afternoon, Hari. I'll try and answer those questions, and Kalol, please feel free to chip in. So the first one was on our company vis-a-vis other hotel companies. And Hari, we, as you know, are in the luxury segment. Now, you'll also know that this segment, with various statistics that you look at in India, is growing much faster than others. And therefore, we believe that there's tremendous opportunity in this segment. This is the segment we want to focus on. This is the segment we want to grow. And if you saw the ROCE details that Kalol shared, even amongst Oberoi and Trident, Oberoi, the premium segment, achieves a considerably higher ROCE. That's also reflected in the average room rates and also on RevPAR. So we believe in this segment. We believe in the future growth of India. And we believe that the segment will continue to grow like it has in the past, maybe even at a quicker pace and a great accelerated pace, which will benefit certainly Oberoi hotels and also Trident hotels in the luxury and upper upscale segments. So that was the first question. The second question was on Wildflower Hall and Mashobra. And actually, we have provided in the accounts, in the consolidated accounts, which both include EIH standalone and Mashobra, 69 crore towards the lease payments, interest, and there were some penalties. Kalol, do you just want to run through those figures to give greater insight on that?
Sure. I'll just maybe, since you've already mentioned the amount, what I'll basically say is that this entailed sum payable from 2005 to 2000 to the date when we accepted the award of the arbitrator. And therefore, we've now provided for the lease rentals as well as applicable, but I would not get too much into the details because the execution petition has been filed and it is sub judice. So therefore, I'll not really get into it. But just to give you a flavor of what happens to the company, I think that was your question. The company has over 200 crores of cash. So obviously, if this were to go through, and this is again sub judice, so please we'll take it with the
Yes,
due.
sir.
Sorry?
No, sir. Go ahead, sir. Thank you.
Yeah. So,
And Kalol, maybe I also made probably I should have said more than I should have. Given these, I think we should really limit what we say. But please feel free, if you share that view, then you can. If you don't, then please go ahead.
yes, so I would, that's where I was coming to it from. And I think, Hari, overall, I can say that it is positive for the company because we've taken a decision, and obviously after charging lease rentals, etc., the rest of the profit would belong to the company. But beyond this, I would refrain from commenting at the moment because it is sub judice.
And the last question, Hari, you had was on Andaman and Nicobar Islands. Now, we would be very interested in a hotel opportunity in either one of those. Of course, Andamans I know well, and they're beautiful islands, some beautiful beaches, and I'm not just referring to Havelock, but to others as well. And as and when these opportunities come up, provided they are on terms that make commercial sense, we would be very interested to pursue these opportunities either on our own or with partnerships. So we would be very interested. That's really all I can say at this point on the Andaman and Nicobar Islands. And thank you, Hari, so much.
Thank you very much, sir.
Thank you, Hari.
Yeah.
Amit, please unmute yourself. Amit Agarwal.
Hello, can you hear me now?
Yes, Amit, please go ahead.
Good afternoon, everyone.
Hello, Amit.
Hello, how are you?
I'm well. How are you, Amit? Nice
Good,
to hear from you.
There's a mention of 13 acre land in 𝐒𝐻𝐿. Can you please let us know the plans for the same? This is my first question.
Sorry, Amit, I couldn't. Your voice is coming slightly ruffled. Could you repeat the question? I'm sorry, I didn't hear it.
Yeah, there's a mention of 13 acre land in 𝐒𝐻𝐿. Can you please let us know the plans for the same?
So is this?
There is a mention of 30-acre plot
13
in
acre.
Gur. Sorry?
13 acre.
13-acre
okay,
plot in
13
Gurgaon. So what is our plan for the same?
Yeah. So this actually is, there's a piece of land in Gurgaon on Sona, in Sona rather, which belongs to the company. And as we were actually thinking of selling this land, we're not now. And we will certainly, when we have a plan for development of that site, we will share those details with you.
Nothing right now.
Nothing that I can share with you right now.
And my second question is, the Kerala boards are not in use, it seems. Any particular reason for shutting down the operation over there?
I'm sorry, you were
The
talking.
question, Vikram, is on MV Vrinda, I guess.
Right. Okay,
Yeah.
so what, I couldn't hear the question. I'm so sorry.
I think they're not in use nowadays. Any reason
Yeah,
for shutting down the operations over there?
Yes, the boat is not sailing at present, Amit. And one of the things that we are really actively pursuing, which was apparent from the slide also that Kallol shared, is really focusing on investing our efforts in assets that give a return. Sadly, Vrinda didn't fall into one of those. And the boat isn't sailing. We're looking at what can be done with Vrinda. It has been it's been written off completely on our balance sheet over the years. So, Kallol, do you want to add anything at all to that?
No, that's what it is, Vikram. The asset has been impaired a few years back, and it's not operational.
And my third question is regarding the Rajgarh Palace, Madhya Pradesh.
Yes.
See, the construction hasn't started yet. As per my information, it's still open for regular tourists. Can you update the status of this, the project as of now?
Yeah, no, Amit, the work at site is continuing. And in Kallol's chart, you'll see we have a chart on when the hotel will also be ready for operation, which was Kallol, that was on 26, am I correct? I can't recall the month.
Yeah, no, it was 25, FY24-25.
24-25. So, but work is well underway, Amit, at site.
Is it open for tourists right now or no?
Is it open for?
Regular tourists?
No, the hotel is under construction.
Okay. And my last question is regarding the Q4 Cafe and the new restaurant, standalone restaurant you're coming up. And this is the big club. Do you think as the management is putting too many fingers in different businesses altogether? Because hotel industry is our main business.
Amit, it is very difficult to comprehend your question because there's a lot of disturbance in the line.
Shall I repeat?
Yeah, please slowly.
Actually, I heard the Naveen. I think I heard the question. I know it's a lot of disturbance, but I think so. Actually, Amit, these businesses are not. They're all related to our core business, which is hospitality. F&B is a integral part of the hospitality business. So that's the first thing. And the Bay Club is it attracts our premium guests. It provides them and their families with exceptional facilities, and it helps us to build and engage with our customers, which not only visit the Bay Club, but also stay at other hotels and pay premium prices at our hotels. So I think it's not a separate business at all. And the Amadeo, which is going to open middle of next month, is going to be an exceptional dining venue overlooking the Geo Fountains, an exceptional location, and we have no doubt that it'll be very, very successful. So it's really in keeping with our business, is certainly the perspective that we've taken. This isn't a business which is outside of hospitality.
Because my worry is that has been there for 2 years almost, but now there's no talk of extension of the whole cafe chain.
I'm happy to. Yeah. No, so Amit, I'll just tell you what happened with 𝗂𝗂. When we opened 𝗂𝗂, our focus was really on a patisserie concept. That's what we thought would work. We realized that is not what it is, and so we've significantly changed 𝗂𝗂's positioning from a patisserie to a casual dining venue. And some of these changes in menu, etc., took place a couple of months ago, and there has been a significant increase in sale. So I still believe in 𝗂𝗂 in the long run. I believe it will do well, and we're seeing some sites of that immediately. And once it stabilizes, we're clear on that this is a workable concept, then of course we'll look at scaling this concept. So I think I've said this before, and that position hasn't changed.
Because the brand 𝗂𝗂 has been taken by many other people. Right now, there's the latest bar just opened at Dubai, which is doing very well, and its name is 𝗂𝗂 again. I just wanted to inform the company.
Actually, Amit, could you just send us details on that, because I'm not aware of it, and if this brand name is registered, so nobody else should be using it. So if you could share those details with either Kallol, myself, or Naveen, I'd be really grateful.
Okay, thank you. Okay, I'll do that.
Thanks, Amit. Really appreciate it. Thank you.
Thank you, Amit. We have a question from 𝐾𝐸𝐻. 𝗂𝗘, please go ahead.
So good part of my questions have been covered by previous participants. My question is to Kallol, sir. Sir, there is an increase in other expense on a QOQ basis. So what is the reason, sir?
Yeah, good afternoon, 𝗂𝗘. Yeah, the increase is actually increase in variable expenses. It's mainly two factors. One of the most important increases on account of increase in commission to travel agents, which has increased because the business has increased as such. So obviously the quantum of commission expense has gone up. And second is repairs and maintenance is also something that was a little subdued during the COVID period. So that has also gone up, but there are several other heads where it has come down. So this increase is not really one to really worry about.
Okay. No, sir. So when we see standalone, the other expenses are flat on a QOQ basis, but when we see console P&L, other expenses are up 50 crores actually. Standalone.
Are you comparing with last year?
No, QOQ, sir. Quarter on quarter.
Quarter on quarter, yeah.
Quarter on quarter. Yeah.
Yeah. So 𝗂𝗘, I mean, quarter on quarter, actually, if you see, there are some expenses which are not incurred during the peak seasons, and they are deferred into the summer seasons, etc. So really speaking, it's all in control. It's nothing really out of the line.
Sure.
Yeah.
And Kalol, it was just, again, maybe we just want to emphasize the point on the increase in flow through. Yeah. No, and also the flow through that you mentioned right in part of your opening presentation. You'd covered that. So, which suggests that expenses are well under control. All expenses are well under control.
Sure.
Yeah, sir, just one last question. Sir, with regard to the underactive discussions pipeline, how close are we for the materialization of this pipeline? If you can highlight something, that would be great, sir.
Right. I think Kalol's presentation has dates on everything, but you know, you would have seen that our existing hotel portfolios performed well. I think we're well positioned as far as these hotels go in terms of future performance as well, I hope. I think we all recognize that a key area of focus of the company and therefore all of us is on growth. And that's what we're focused on today. And we will, as soon as we have information to share with you on growth, we're working on this every day. And this is, if there's one thing that gets leadership's attention, it is to drive growth. So I hope all our efforts will have a positive outcome and we'll be able to share something with you in time to come. And hopefully that shouldn't be too long. So that's what I'd like to add to that, Kirti. I hope I've answered your question.
No, so what I meant was in the slide 30th, on left-hand side bottom, you have mentioned that the underactive discussions, Oberoi Hotels 3, Trident 7. My question was pertaining to that, sir.
Yeah, so they're all, and my answer would remain the same. We're pursuing these with great determination, with great energy, and with great passion. And with all those three things in place, I hope we will be able to share details with you soon.
Sure, sir. That's it from my side. Thank you.
Thank you so much, Kirti. Really appreciate it. Thank you.
Thank you, Kirti. We have a question from Bharat Sheth. Bharat, please go ahead.
Hi, am I audible?
Yes, Bharat, loud and clear. Please go ahead.
So, Mr. Oberoi, thank you for the opportunity. Sir, when we are talking of driving a growth and we are seeing a big opportunity in the luxury segment where we are present, so what will be in absence of a new addition of the new hotel, what will drive our growth in short term and medium term? How do we really take this growth strategy going ahead?
Bharat, a very, very good and a very fair question that you ask. So there is still, you know, if you look at hotel prices in India, and we've seen rates go up for us, you know, whether it's Oberoi or Trident, and this is also an industry or hospitality trend in India. But even today, if you compare the quality of hotels that we have today with most parts of the world, our hotels in India are really underpriced. For the quality of hotel and the quality of service you get, these hotels are very a great value. Now, I'll give you some insights, and this is a function of supply and demand. We have a hotel in Gurgaon, and this at the Trident Gurgaon, and that used to do an over 20,000 average room rate. So really, and this is, you know, the hotel opened, if I remember correctly, in 2006. So these figures that I'm quoting you may be 2010, 12, I don't remember exactly. The point I'm making is that there is considerable upside in average room rate, and there is also some upside in occupancy as well. So I think in the short to medium term, there's quite a lot of headroom, both at Oberoi and Trident hotels.
Yes, sir. And how do we see, because these higher ARR are largely contributed by foreigner visitors, whereas, I mean, we understand this is still has not really pick up the way it should have domestic traveler is. So what is your sense on when do we see really foreigners start with visiting more or occupying that can help in improving ARR as well as occupancy level?
So two things, Bharat. First of all, as Indians, our propensity to spend is actually very high. And we've seen that if you look at the presentation that 𝐾𝐽 has, foreign occupancy hasn't. So there are two slides in 𝐾𝐽's presentation. One shows the occupancies, foreign occupancies, and the other one shows average room rates. So you can see foreign occupancy hasn't come back, but you'll also see that average room rates have grown considerably despite that. So our Indian guests, or we as Indians, are more than happy to pay those rates for a quality experience. That's the first point. The second point is that we certainly expect foreign business to bounce back to, or hopefully even surpass COVID levels in this coming winter, and that will help our hotels further. So I think both those signs are positive, both for rate and for occupancy.
Vikram, if I may add to what you said, basically, Bharat, if you see the last several quarters, it was not as if visa requirements, etc., were very relaxed. So therefore, it was people in different countries really found it difficult. So those are easing. Foreign travels arrivals are also going up. So really, we have a case for optimism here.
Okay. And when do we expect a new hotel to be operational in for our company?
We've given a chart, Bharat, on slide number 30 on all the upcoming projects which have already been announced, and a list of 11 hotels which are under active discussion, which will be announced shortly.
Okay, fair. And my one more question is about normally when we open a new property, normally how long it takes to break even or start contributing at EBITDA level?
It varies from location to location, but I think our industry, generally it's between 3 to 5 years, depending on the location.
Fair. And last question for our CFO. So I've seen that in standalone, our Q4 is always better than the Q3, whereas if we look at on console, whereas Q4 is a little lower. So what is that seasonality is there in console level? That is really, if you can give some more color into it.
Well, I'll first begin by saying that if you see the composition of the consolidated results, so one large chunk of that is international. And international, the hotels have two kinds of financial reporting. Some hotels are on a financial year basis, some are on a calendar year basis. So therefore, in case of some of the hotels which gets consolidated on a one-line consolidation, there in the last, the results which are incorporated are as of December of the last year. So obviously there's a seasonality effect there, but that really does not change the whole perspective. I think the point that is very relevant for us to consider, and which we are very actively pursuing, is there is a major shift and focus on how to really make our international business extremely profitable. They are great properties and very well appreciated by guests, but they need to perform as good as the Indian hotels, the hotels in India do, which their management is very, very well seized of. And hopefully going forward, we'll have similar kinds of trends, both for standalone and consolidated results.
And thank you, and wish you all the best, sir.
Thanks so much, Bharat. Really appreciate it. Thank you.
Thank you, Bharat. The next question is from Saurabh Patwa. Saurabh, please unmute yourself and go ahead.
Yeah, am I audible?
Yes, you are.
Yeah. So just wanted to understand your thoughts on so the kind of hotels which we have on the luxury side. And I think we believe is largely that's why we have a larger proportion of owned and versus lower proportion of management control. Is this acting as a sort of a roadblock in increasing the pace of growth? or we essentially we want to remain focused on owned versus not going for a lot of management controls, management.
I think for us, Saurabh, we can grow through management contracts. We can grow through hotels where EIH is an owner, like many of the EIH hotels, or we can grow through partnerships. And growth is very important for us so that we are in locations where our guests travel to, and also important to us for the career aspirations of our colleagues, so we can offer them growth as well, and also grow the company profitability, both top line and profitability. So we at EIH are happy to pursue all those options for growth. There's no one single pill. We'd be keen, and we're actively pursuing opportunities in all three areas.
If I may just add to what Vikram said, and I'll give a financial perspective to it, Saurabh. I think firstly, it's a good question. I think if you study the company's balance sheet and profit and loss accounts very carefully, including consolidated, you would see that all our subsidiaries and EIH is today a debt-free company and has sufficient amount of cash reserves in hand, right? We have also listed out the projects which are going to be managed, which are going to be good, etc. So what you will realize if you really do a deep dive is that along with the company being cash surplus, obviously that lends us enough credibility to raise an amount of debt which the company can sustain, which really adds up to say that there is quite a bit of funds in hand, which we can easily deploy over the next 3 to 4 years. And if you correlate that with the point that the return on capital employed that I've shown to you on a slide, really speaking, when these hotels that are built, they really provide the return on capital employed, you can see the difference in management fees versus only earning management fees versus the difference in overall earnings if the hotels are owned. So to answer your question in short, I think it has to be a mix, and that is what the management is pursuing. It has to be a credible, balanced mix, and quality is our topmost priority. Therefore, really speaking, going into the volume game to get many managed hotels is not really something that we would want to run. But having said that, we are very, very well positioned to deploy our funds adequately over the next few years, and therefore generate very high returns for our shareholders.
Yes, actually, so my next question was related to link to this, the response which you already provided and few of the answers which you provided in the past. So the way you have highlighted, like normally any new hotel would take, like say, like on an industry basis, 3 to 5 years. And since the addition of hotels in for us in next 2-3 years is would be very minimal, we would be essentially betting on operating leverage, and that's why the growth in revenue would be outpaced sharply by the growth in profitability. Is it a fair understanding?
Sorry, Vikram, you want to take that, or should I?
No, go ahead, Kallol. I was trying to really understand the question, but please go ahead, Kallol.
So Saurabh, again, if you see, really speaking, the results that you've seen this quarter and for the financial year is just the reverse, right? The growth in profitability is actually higher than the rate of growth of revenue. Now, that's possible because of a number of reasons. And like Vikram mentioned earlier on, I think there is still enough and more upside on the room rates front, and which therefore really the flow through to EBITDA in case of room rate growth is much higher. So therefore, we don't see that really as a concern. But also to say that I think you mentioned that we have limited properties which we are talking about. That may not well be the case if you wait for the year to go by. Probably you'll hear more such announcements. Just that we are today in a position where we wouldn't like to really jump the gun, but surely that's not an assumption that one should straight away make.
So that is exactly what I wanted to understand. Thanks a lot.
Thank you. Thank you.
Thanks, Saurabh, and thank you, Kallol.
Thank you, Saurabh. We have a question from Yashovardhan Agarwal. Please go ahead.
Yeah, hi sir. Am I audible?
Yes, Yashovardhan, please go ahead.
Yeah, hi sir. Thanks for this opportunity. I have few questions. So first on the industry competitiveness. So as we are in the luxury segment, so there are other companies like IHCL and even the Marriott is like very bullish on the Indian market. So what is our competitive advantage if we are competing in this industry? Like how are we competing against them? So if you can answer that on that, so that would be helpful.
Sure, Yasho, or Yashovardhan, sorry, I shouldn't shorten your name, I apologize. I mean, what really our guests tell us, and this isn't our perspective, it's our guest perspective, that we provide guest experiences that are the best in the industry. And therefore, guests, number one, value that. They see that as distinguishing us from others, and they're willing to pay a premium for that. And that is reflected in the RGI index that Kalol had shared earlier on.
That's slide 5.
Yeah. So that's it's at 127, of which rate is 120. So and this is against, just to clarify, this is against, in each location, we define our competitive set. So these are against hotels that we believe that we directly compete in. With STR, you need a minimum of 4 hotels. So these are the leading hotels in each of the locations where we operate. And STR data indicates that we considerably outperform our competitors in these markets. You know, our guests' views on us is what's important. And we know from data and from what our guests tell us that they appreciate the quality of our hotels. They appreciate the quality of personalized care and attention that our colleagues give to each and every one of our guests. And most importantly, that creates loyalty, and they're willing to pay a premium over our competitors to stay with us.
Okay, so that's so that would be the only competitive advantage, or like is there any other point you would like to add?
So I think that's the key thing, if I've understood your question correctly, but if I've missed something, please help me.
So Yashovardhan, I'll try and just add up to what Mr. Vikram said. So that slide 5 that we've presented is data from 2019 to 2023. And in every single quarter, you would find that our average ARR index is higher than 100. Similarly, the RGI index is also higher than 100, which obviously means that the competitive set in which we are operating, we are able to really derive a premium for the quality of services that we provide. So that should be, if that trend is prevalent for 4 years, then I think that's quite an established trend.
But Yashovardhan, if there's something you feel, I really meant that seriously. If you feel we still haven't answered your question, please feel free to elaborate further, because obviously we would like to answer your questions, and we may learn from what you ask us or tell us. So please don't hesitate.
Yes, sir, sure. So thank you for that. So what I'm saying is that if we listen to the management commentary of other hotels, so there are many hotels which are in their pipeline, and many hotels and rooms are coming into the market, if we say in next 3 to 5 years. So supply is increasing a lot, and so we are saying that the demand is also increasing. So my question is that I got that point, the guests will come to us in case of that we are providing them with a good services and all. But sir, is there anything else that we could be saying that we are having locations, for example, at very good locality, or the hotels that we are having, so the locality in which they are very good, and we are providing them with a good service, but is there anything else in which we can say that we are superior to our competitors? So on that, I am looking for more clarity, if you could help me in that.
So Yashovardhan, we I'm not here to comment on our competitors, who I'm sure do a fine job in the hotels that they operate. But what I can maybe just add, given what you said, is that we need to be in locations where our guests travel to. And I think I made that point earlier on as well. And we are entirely focused on meeting, if not exceeding, that objective. So, and that comes down to your point on growth. Absolutely, we need to grow. We need to grow in locations where our guests travel to, and we need to grow with profitable hotels, either for our owners, if it's a management contract, or our partners, if it's a joint venture, or if it's an EIH hotel, grow profitably as well. So our efforts are focused on all three of those.
And also I'll add that our balance sheet is very strong. And as I described in one of my previous replies, that leaves us with a potential to really execute projects and profitable projects. And we have access to enough capital for that.
Okay, so got it. And thank you for this opportunity and good luck.
No, thank you so much. Really appreciate your elaboration as well. So thank you.
Thank you, Yashovardhan. We have a question from Rajiv Bharti. Rajiv, go ahead.
Yeah, good afternoon. Thanks for the opportunity.
Hello, Rajiv.
So on slide 21, you had this direct channel, which is has increased materially in terms of contribution. And then you had said that your OTA commission has increased. Somehow, those two comments, can you throw some more light on that?
The OTA is actually a means to booking, so it's included. It's guests coming directly to us, but using an OTA. So that comes within the direct segment, Rajiv.
Sure. Okay. And you have specified the flight catering business for the quarter. Is there seasonality in that, or we can multiply that by 4 to get let's say a FY24 trajectory?
I don't want to give forward. Ksal keeps telling me that I can't give forward-looking statements, and so I better not. But we remain. The flight kitchen business went through a very, very difficult period due to COVID. International travel, as you know, stopped. There were then limited flights. There was domestic airlines that also greatly reduced the number of flights, and that increased over a period of time. The flight kitchen business for us is our largest contributors are international travel. And we've seen, Ksal has presented a slide on foreign arrivals into India at our hotels. And I know that people in India are traveling more internationally as well. So I think we're well positioned with all the key drivers for growth increasing, particularly in winter. Just to answer your question, that is greater in winter. There's greater travel to India internationally in winter, so from October to March. And that will be reflected in the numbers, no doubt.
And if you can provide, let's say, what is the ballpark margin at which this segment operates at? I mean, I just want to derive, what is the hotel's business margin, because this kind of dilutes that, right?
Yeah. Ksal, can you? I don't know if you can.
Yeah, so ballpark margins are between 20 and 25% EBITDA. For OFS, you were asking, right? For the flight catering and the airport catering business.
Yes. Yeah.
So it's a combined percentage that I mentioned. However, if you were to do a split between them, that's really going really deep dive, which you always do, I know. The airport catering business is actually more profitable than the flight catering, but flight catering is also equally profitable. And with the competitive landscape that is opening up in India today in the aviation sector, I think there is a high propensity for rates to really go up.
Ksal, would it be fair to also say, and again, I don't know if we should be making these statements or not, but I'm not talking about us in particular, but there is a capacity constraint for this segment. with limited suppliers and demand picking up. So there is a capacity constraint, which should see prices going up, and with prices going up, margins going up. Would that be a fair comment to make?
It's absolutely a fair comment, and I'm sure our analyst friends would be able to easily work it out as to how many number of flights are potentially going to get added in the next couple of years, and what is the capacity of, there are only limited set of caterers. What is the total capacity available? If you really correlate the two, you'll see the deficit in capacity that is getting projected. So I think there's nothing wrong in saying that. I'm sure Rajiv can find that out.
So on the arbitral awards, so you mentioned that the thing is sub judice, but in terms of what is the potential risk, or in terms of this number ballooning even further, apart from the number you already provided for?
Well, the management has made a best estimate, and therefore this is the best estimate of the risk that has already been provided for in the accounts as of date.
And why is there a differential between, pardon my understanding on this, and the standalone and the console? So there is a 10 crore on the standalone. Yeah.
See, the difference is because the lease rental payment is payable by that company, the subsidiary, which is Mashobra Resort Limited. So obviously that comes in from the consolidated part into the EIH accounts. Whereas EIH's liability is only towards the initial building of the project and all of that. So obviously the liability for EIH to the government is much less as compared to the liability of Mashobra. That's why the standalone figure is lower and the consolidated figure is higher.
Yeah, great. And sir, in terms of divestment, is there any talks of considering Oberoi Mauritius divesting that? Seems they are contributing to losses in the contribution to the profit of farm associates.
Are you talking of EIH Flight Services, or are you talking of Oberoi Mauritius?
Oberoi Mauritius and Mercury car rental piece, which is part of the profit of share from associates. Because otherwise, Marrakesh should have contributed to profitability, but X of that, the number is a negative number.
I'm not sure if Vikram wants to answer that. I can answer that as well.
Yeah, no, please go ahead, Chloe. These tough questions, you know, these very difficult. So I think you can answer them.
No, Rajiv, Rajiv always asks tough questions. So, I think you'll have to wait a little for the Oberoi Marrakesh to stabilize, because it opened in December 2019, and in March 2020, COVID hit, and then the hotel was closed and all of that. So we are the newest entrant in the market there with a beautiful and outstanding product, which is just beginning to really pan out with reviews, etc. So you'll have to wait a little before Marrakesh really comes in. And about Oberoi Mauritius, there is no reason at the moment to really believe that there's a need to really look at it. Of course, there are renovation plans, etc., which are being currently assessed. And as soon as we come up with a plan, I'm sure, that will be available to you. But on divestment in general, if you say, I think in our previous analyst calls in previous years, we have always articulated that there is a need which management has felt that we need to really move away from investments which have not yielded us profits. Two of them we have successfully done in the last 1 year. One was the EIH printing press, and one was the EIH Flight Services Mauritius, which has also been the whole transaction has been completed. So I think as of now, and we already mentioned that, there are other businesses are all really in a state of rebound. So we are in no hurry to really look at any further divestment plans, but if there are any, then we'll be happy to come back.
Yeah, and the last question is in terms of the dividend payout ratio. So you used to have 50% dividend payout some years in the past, and this time around the number is lower. Are you working towards it's a certain number for the upcoming projects, and then the payout ratio would go back to the historical levels?
Well, Rajiv, the percentage is actually higher than 50%. I know you're talking about dividend payout. And the reason why we want to, really emphasize, and I think Vikram has adequately covered that, is that we want to strike a balance between distributing dividends to our shareholders versus retaining funds for our future growth, because we are very aggressively looking at going ahead with projects. So therefore, we need to be careful to maintain that balance, and which is why even though we have increased the rate of dividend The rest of the fund is actually available for growth, which I'm sure will benefit shareholders because in the long term, asset value accretion is probably as important as dividends.
Yeah, just one last thing. On the receivable, there was a Center of Excellence initiative which you guys had. On the receivable number, is there any more juice left, or you're happy with the current number?
Well, receivables, I think, has really done phenomenally well. If you see what used to be with much lower sets of turnover, if you go back to previous years, the debt used to be well over 200 crores. Now the debt, even with way higher turnovers, it's still around those levels. But out of that, about 40 crores is on account of internal debts. So really speaking, debt levels have come down a lot. But yeah, if you say, is there any more room left for further improvement? There's always room for improvement, of course. So we continue to find out ways and means to improve our excellence. I think the Center of Excellence has really done very well for us, especially during the COVID years. And we are definitely looking to refine it further along with our colleagues in operations.
Thanks a lot and all the best.
Thank you, Rajiv.
Thanks, Rajiv. Thank you.
Okay, the next question is from Tarang Agrawal. Tarang, please go ahead.
Hi, good evening. Thank you, Mr. Oberoi. Thank you, Kallol, for giving me this opportunity. Just steering wheels towards the international business, if you could give us a sense on how the revenue and the profitability for the international business alone panned out for FY23 versus 22. Number two, is there any debt specifically on the international business? And number three, across the 7 properties that you have there, I mean, a couple of them in Bali, one in Mauritius, and the balance in the other parts of Africa. If you could just help me understand, which are the stronger properties right now from a P&L perspective, and which are up and coming.
Hello, over to you. Two tougher questions.
I thought I'll give it to you. So Tarang, yeah, I think
Tarang always asks tough questions. So thanks, Tarang.
So Tarang, the reason why we would in terms of profitability, let me tell you what the businesses have been profitable at EBITDA level, but we've also worked very closely towards looking at whether because we also want to be a very well-governed organization. So there are some losses that have been accumulated in the current year's consolidated accounts, but that is primarily because of some impairments that we have taken on some of our assets. Some of our assets, for example, the Oberoi Bali and the Oberoi Mauritius, really need renovation, although they're doing very well. They're achieving good rates as of now. If you see, Oberoi Bali is doing average room rates of around $300. Vikram, please correct me if I'm wrong. And the Oberoi Mauritius is also doing about 625 odd. Marrakesh is really flying away. So really, I don't want to speak about that. That's our newest property. But overall, I think
over $800.
Over $800 per room night. So yes, they're doing well, but I think the focus of our attention for the last 2 years was more on India because we were just struggling to come out of COVID. Now, having established that and with our colleagues really taking full control of the India operations, it's time for us to also look at what is happening internationally. So therefore, I wouldn't dwell too much on the past performance, but obviously going forward, I think we will have better news to share insofar as even PAT flow through to EIH is concerned.
But I mean, some sense on the international top line and EBITDA for FY23, because while ARRs sound nice, I'm not too sure how occupancies are panning out there.
No, occupancies are also not bad. It's the difficulty of discussing a figure is because these properties are all in different geographies. and in different currencies. So they get translated many times before they reach the Indian rupee. For instance, the rupaya going to dollars. So really, it'll be difficult to give a straightforward answer if you want to really analyze. And I'm happy to take it offline if you wish in a separate discussion to explain to you the way it is done. But really, it'll be in a conference call like this where we have very limited time left. It may be difficult to really explain.
I understand. Just last, is there any debt on EIH International or any of your EIH International subsidiaries?
No, Tarang, there is, that is the best part of our balance sheet. None of our companies, including the parent company or any of the subsidiaries or associates, have any debt on books as on date.
No gross debt there, right?
No.
Okay. Thanks. This is helpful. Thank you.
Thank you so much.
Thanks, Tarang. If there's still something unanswered, let me know. We'll pick up a call.
Sure. Thank you.
Okay, we have a question, a few more questions. 𝗗𝗘𝗠𝗔𝗃 𝗚𝗚. 𝗗𝗘𝗠, please go ahead. 𝗗𝗘𝗠𝗔𝗃, please unmute yourself and go ahead.
So my questions have been answered. Thank you. Thank you.
Okay, great.
Thanks, 𝗗𝗘𝗠𝗔𝗃.
𝗃𝐿𝗓𝗃 𝗃𝗃𝗃, please unmute yourself and go ahead.
Yes, thank you. I just wanted to come back to the question about expansion and maybe ask it a different way. Would love to get your thoughts on maybe two factors as relates to your growth strategy. The first part is just where we are in the industry cycle and whether, because of the rising income levels, for example, within the domestic consumer, that might reduce the seasonality or the risk of seasonality from international travelers, and how maybe this industry cycle might allow you to be more aggressive. That's the first factor. And then the second is in terms of wanting to maintain your brand equity. And so this maybe relates more to management contracts, but I guess the level to which that focus on maintaining the brand.
When it gets very hot in the north, Delhi, etc., people will then go up to hill stations. We have hotels in Simla. So I think in time, and we've already seen this trend, seasonality has been coming down over the years, if I were to take the COVID period out of it. In terms of the quality of hotels and our ability to secure management contracts. In fact, this is one thing we learned from Mr. Oberoi, Chairman Emeritus, and in those days he was chairman. He said, it's when you are partnering with somebody and they are relying on you, you have to be even more careful with giving your owner a return. And therefore, we get many opportunities. If we do not believe the hotel will be profitable, we do not pursue those opportunities because it's just creating a problem for the future. So we have to believe, we have to do our analysis, and we have to know with a high level of certainty that we will give a good return to the owner. And we've demonstrated that with our Gurgaon hotels, with Sukhvilas. We have a fourth hotel with the same owner. And we take great care in our partnerships or in management contracts to ensure that we only pursue projects where the owner will be happy with the returns that we can generate. So I don't know if I've answered your question. If I were to just maybe say one other thing, we do get opportunities that we do turn down for that very reason.
Okay, great. That's very helpful. And maybe just to follow up on one of the earlier questions, there was a question just about where the growth might come from the next few years. Right, and you mentioned some of the options you're looking at, including management contracts, including some of the hotels that are still under discussion. I guess the question is, were you almost implying that we could see growth from some of these hotels that are under discussion, in some of the early years, not necessarily the out years, or is that is that something you were not implying? Thank you.
So if your question is on timing, I hope we'll have positive news to share with you. We're as eager, or we're very eager to share that news with you. And as soon as we're in a position to do that, we will do that.
Great, thank you.
Thank you so much.
Thank you, Nikunj. We have a question from 𝐒𝐻𝐫𝐭 𝐶𝐻𝐿. Javeer, please go ahead.
Sure. Thanks for taking my question. Good evening, Mr. Oberoi and Mr. Kundu.
Hello.
So firstly, given the TCS imposition, 20% TCS imposition from 1st of July, I mean, how do you think about it in terms of, one, your domestic rates and also the impact on your international business? Can you provide your views there?
You're talking about, when you're saying this is the tax that is deducted on foreign travel.
The foreign spends, yes,
Yeah.
That's right.
I mean, I'm sure that will help Indian hotels, including us. The extent to which I'm not sure, but I would say just, if you're a traveler or a guest or somebody who travels and you need to make a choice between an Indian hotel and traveling overseas, I think your take on this will be probably greater than the insight we can offer. Our perspective is just from consumers as well of hotels, and finally it's really our customers who make the decision. But I think more than that, I think the greater impact comes from a trend we're seeing where people are taking more breaks and shorter breaks, and those are a large proportion of them, I presume, will be in India. I think for the really affluent, this may not have a direct impact, but we have a wide spectrum of guests, and for some, I'm sure it will, for others, it may not.
Understood. And I also want to pick your brains on the hotels upcycle. Now, given that most of the hoteliers are posting all-time high profitability and also expanding because of that. So one, how long do you think this upcycle could last? And secondly, when I look at your ARRs or even that of your competitors, these are probably 30-35% up versus the pre-COVID levels. So one, given the FTA recovery, what further room do you think there could be on the ARRs? Yeah, these are my two questions.
So I think, ARRs really are a function of what the supply is and what demand is. I used to work at our Bombay hotels years ago. This is in, I think it was when India first started to liberalize after the first Gulf War. And we saw, demand just shoot up. The hotel was full, our South Mumbai hotels were full all the time, and rates suddenly, within a short period of time, shot up drastically. So there's limited supply coming in, and supply does take time. So I think there is, certainly in city locations, also the hotels that have been there for some time occupy premium locations that are no longer available. And location for city hotels are very important in a guest choice. So I think, in my view, if demand continues to be strong, there's considerable upside in average room rates. And our city hotels in India are very underpriced when you look at other markets around the world.
And Mr. Oberoi, given that most of the people say that the supply is likely to take another 3 to 4 years to come in, but aren't you seeing a lot of acquisitions happen, a lot of management contracts, because there are a lot of distressed assets available as well? So could supply hit much earlier than what probably the industry is expecting, and then hence sort of matching the overall demand growth? I mean, do you fear that?
I don't think we don't fear it. And maybe we should. We don't fear it. I mean, we've looked at in the past a number of hotel assets and not pursued those opportunities because to refurbish, redevelop these assets and to make them into hotels that certainly could be an Oberoi or a Trident. We've at least thought that that would be challenging. Now there may be others who can do that. I can't really say, but you know, guests will pay a premium for quality hotels and for quality service. That we're certain on, and also quality locations, particularly for city hotels. For leisure hotels, there's a greater flexibility on location, and the premium hotels today in a particular city already have those well covered. A very good relationship with them, and they're there. They supported the company during COVID with the rights issue, if you recall. So it's there's really nothing perhaps other than that I want to add. We have the full support of the two Reliance directors, who are very supportive in the advice and guidance they provide us at a board level, and we greatly appreciate that and value that.
I hope that's answered your question, KK. Thank you very much, Vikram and Kalol, for patiently taking all the questions. I hand over the call, the webinar, to Vikram for his closing remarks. Please.
Naveen, no, first of all, thank you to you. Nothing more to add. I hope this year will be better than last year. We're going to work very hard to drive the best top line we can, the best bottom line we can, and there's always opportunity to improve. And every rupee counts. And certainly, as far as our general managers are concerned, as far as the corporate function heads are concerned, in fact, all our colleagues are concerned, we want to do whatever we can to provide our guests with a great experience. We want to do whatever we can to drive every rupee on top line and every rupee on bottom line. Every rupee counts, and we're focused on achieving that. So other than that, thank you so much. Really appreciate all the questions. Some of them were very difficult, so please be kinder to us next time. But thank you very much.
Thank you so much, Mr. Pachisia, and thank you so much, Naveen. And thanks to all of you, ladies and gentlemen. We are always happy to answer questions, even if it couldn't be done within this time slot. Thank you so much.
Thank you very much, ladies and gentlemen. If there are any further unanswered questions, please feel free to send them to me. I've shared my email ID, and we'll take them up with Kalol. Thank you very much, Vikram and Kalol, once again, and I look forward to hosting you again.
Thanks so much, Naveen. Really appreciate it. Thank you so much.
My pleasure.
Bye-bye.
Thank you, and have a lovely evening. Bye-bye.
Yeah, you too. Bye-bye.
Recording stop.